CoreWeave's revenue more than doubled to $2.58 billion, but adjusted operating margin collapsed from 16% to just 5%. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. CoreWeave gets graded and traded. So on the headline, revenue came in less than 1% ahead of estimates. Basically, an inline number. But the year-over-year growth is where the story is. Revenue more than doubled to $2.58 billion, up 112% from a year ago. And on the EPS line, they beat estimates by about 31%. That's a solid beat, though on a company still running at a net loss, it's more about the size of the loss coming in better than expected than actual earnings power. So on the beat itself, this earns a B. A modest revenue inline paired with a 31% EPS beat is a good print. Just not a blowout given how much this stock moves on any AI capex headline. And on consistency, this earns an A. CoreWeave has been a reliable beat and raise story since coming public, and this quarter keeps that streak going. Let's talk about the positives from the report. Revenue more than doubled year over year to $2.58 billion, up 112%. That's not incremental growth. That's the AI infrastructure demand curve showing up in the numbers. The backlog is the number that really jumps out. $104 billion of contracted revenue as of the end of June, plus another $25 billion added in early third quarter. That's roughly 10 times their annualized revenue already booked. On the capacity side, they grew active power by nearly 500 megawatts to 1.5 gigawatts, and they completed the industry's first bring-up of NVIDIA's Vera Rubin NVL72. That's real technology leadership. They also landed a slate of new enterprise customers: Bentley Systems, Caterpillar, Grammarly, Isomorphic Labs, which broadens the customer base beyond just the hyperscalers everyone already knew about. And operating cash flow swung to positive $679 million versus a $251 million outflow a year ago, so scale is starting to convert into real cash even with the heavy spending. So on profitability, this earns a C. Revenue doubled, but GAAP operating income flipped to a loss, and adjusted operating margin fell from 16% to 5%. The demand is there, the margin leverage isn't yet. Now, let's talk about the negatives from the report. GAAP operating income swung to a $49 million loss versus a $19 million profit a year ago, and adjusted operating margin compressed from 16% down to 5%. So the depreciation and infrastructure cost curve is outpacing revenue leverage. Interest expense more than doubled to $640 million from $267 million a year ago. That drove a net loss of $626 million for the quarter. The leveraged funding model is a real drag, and it's only going to get bigger as more debt gets drawn. Adjusted EBITDA margin also slipped to 59% from 62%, even with revenue more than doubling. So even the non-GAAP profitability line isn't scaling faster than revenue, which complicates the bull case that scale automatically means margin expansion. Capital intensity is extreme. $6.4 billion of property and equipment purchases in the second quarter alone against $2.58 billion in revenue, and total debt is now above $35 billion against about $5 billion in stockholders' equity. That balance sheet is stretched. And there's real customer concentration risk. A $104 billion backlog sounds great, but a lot of that is likely tied to a small number of hyperscaler and AI lab counterparties. The press release doesn't break it out, but the named customer framing suggests a top-heavy book. On guidance, this lands at a C. The press release didn't include forward revenue or EBITDA numbers, so this is reduced visibility, not evasion. I expect them to address forward guidance on the earnings call. And on red flags, I'm at a C. The demand side is bulletproof, but $35 billion in debt, interest expense doubling, and concentrated backlog counterparties are all things I can't dismiss. Putting it all together, this is a print where the demand story is as strong as it has ever been, and the profitability story is getting harder. $104 billion backlog and revenue, up 112%, tells you the top line is essentially locked in for years. But GAAP flipped to a loss. Interest expense doubled. And adjusted operating margin got cut by 2/3. So the debate shifts from can they book the demand to can they finance and deliver it profitably. I'm giving this print a B-. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. So the bull case here is real for me. The $104 billion backlog and the NASDAQ 100 inclusion tell me the demand is there and the story is legit enough to start building a position. But I'm not chasing this thing. $6.4 billion in capex in a single quarter and interest expense doubling. That's a balance sheet screaming at me to be careful about entry price. So my plan is to wait 3 to 5 sessions for the implied volatility to crush after the print, then sell cash secured puts at strikes well below spot rather than paying up for shares at the highs. I wait and sell puts in. When I'm selling puts on this name, my lowest acceptable strike sits at least 1 full standard deviation below where the stock is trading, because this thing can gap hard on any AI capex headline. And every strike I pick has to be a price I'd genuinely be happy owning the shares at. If I flinch at assignment, I picked the wrong strike, full stop. I'm not selling anything close to the money here. With over $35 billion of debt and margins compressing, the premium just isn't paying me enough for that risk, even with the elevated volatility. Strikes way below spot only. I'm holding my core position here. The $104 billion backlog, the $25 billion added early in the third quarter, and the $1 billion Jane Street strategic investment all tell me the demand thesis is not just intact, it's getting stronger. That said, if the stock spikes above the pre-print highs, I'm trimming a piece to free up cash. That way I have dry powder to add back on the next AI capex pullback that will inevitably come. What I'm not doing is adding on this strength. Adjusted operating margin went from 16% down to 5%, and paying up while profitability compresses is not how I want to size up. Hold core trim spikes. If these were my covered calls, the backlog print and the Vera Rubin NVL 72 milestone are bullish enough that I don't want my shares called away at strikes I set before I knew any of this. So I'm rolling my calls up and out, and I'm targeting strikes that sit above the immediate post-earnings high, not right at it. I want real headroom above the reaction. The elevated implied volatility means I still collect solid premium on those higher strikes, and the underlying gets room to work if hyperscaler capex commentary keeps flowing in my favor. Roll up and out. On the leaps side, I'm holding. The $104 billion backlog plus named Enterprise, wins like Bentley, Caterpillar, Grammarly, and Isomorphic Labs extend my revenue visibility out 12 to 24 months, which is exactly what a leaps thesis needs. But I'm not aggressively rolling my strikes up yet. Adjusted operating margin dropped from 16% to 5%, and until profitability stabilizes, I don't want to lock in a higher cost basis on my long calls. My equity return depends on interest expense and depreciation settling down before the market gives this a higher multiple. The demand piece is confirmed. The profit piece is not, so I'm patient. Hold, don't roll up yet. The demand thesis got a huge validation on this print. Revenue up 112% year over year, backlog at $104 billion, and the first Vera Rubin NVL 72 bring up confirms the technology leadership too. So I am willing to average down here, but I'm doing it in small pieces spread out over time, not dumping fresh money in all at once. The thesis is intact, but the entry timing still matters a lot. The reason for that discipline is the balance sheet. $31.4 billion of recourse debt against about $5 billion of equity means any AI capex sentiment shock hits this name harder than peers, so I respect the leverage in my sizing. Add slowly in small pieces. Bottom line, this print earns a B- from me. The backlog and demand picture are exceptional, but the margin compression and the interest expense curve are real headwinds that aren't going away next quarter. This is a name where I stay constructive on the story but respect the leverage in how I size and how I set my strikes. Thanks for watching, and I'll see you on the next one.